The S&P 500 has now closed higher for 8 consecutive weeks. This is the longest streak of weekly gains that we've seen, dating back all the way to the end of 2023. And if you've been anywhere near financial media this past week, and I mean any, left, right, mainstream, or alternative, this isn't the picture that they're putting forth. Instead, you've been getting a lot of articles regarding Fed hawkishness, ongoing tensions in the Middle East, and treasury yields creeping higher. And these are all very real factors in today's market, but here's what I keep coming back to. The actual market, where capital is being committed and deployed, doesn't seem particularly bothered with these negative headlines. And that gap between what the commentary is saying and what the price action is telling us is what I want to focus on in today's video. In my opinion, there's a framing problem that I think underlies most of the confusion right now in the market. And it's this. People treat market prices and market commentary as if they're signaling the same thing. They're really not, and it's really not even close. Market prices are, and I want to be precise here, they're a real-time print of where large pools of capital are being deployed by institutions that bear actual financial consequences for being wrong. Think hedge funds, major banks, etc. That's not an opinion, that's just how the structure of capital markets in today's world work. Financial commentary, on the other hand, whether it be news, social media, even a lot of sell-side research, it's optimized for something else. It's optimized to get attention. And attention, historically, gets captured by fear and uncertainty far more reliably than by calm and stability. And I'm not knocking anyone, that's just the incentive structure in today's markets. So when prices and commentary diverge this sharply, and right now they're definitely diverging sharply, the question I want to ask is not which one is right. The question is, what are they each actually tracking? Because they may not be tracking the same thing at all. Let's start with what Fed Governor Waller recently said. And I want to be careful about how I characterize this. He recently said that a rate hike is not off the table if inflation remains elevated. And I'm here to tell you that not off the table is not a forecast. It's not a commitment. It's a statement that gives the Fed optionality in how they approach future rate decisions. Central bankers say this kind of thing deliberately. It's part of how they manage expectations without actually moving rates. The market, particularly the fixed income market, has decades of experience reading these kinds of comments, and it knows the difference between a warning and a policy signal. Here's what the bond market is actually telling us right now. As of the time of recording this, on Sunday, May 24th, the 10-year Treasury rate, one of the most impactful rates that also plays a role in determining auto loan rates, mortgage rates, and even more, is at 456. 456 is elevated, yes, but it's not pricing in a rate hike cycle. What it's pricing in is a hold, a prolonged, higher for longer hold. And at this point, the market has more or less accepted this. The adjustment to this rate environment has already happened. It's not in front of us, it's behind us. Corporations have already game planned for the years to come. Earnings models at the large cap level have already absorbed this cost of capital in their forward guidance. A recent Fed speech by Waller doesn't reopen that adjustment. What it does is give financial media something to write about for the next 48 hours before it fades. Tensions in the Middle East are the talk of the town these days, and it's impossible to escape, really ever since the conflict began in late February. Normally, and I want to emphasize this, normally, geopolitical tensions in the Middle East lead to a sharp spike in energy prices, I think oil, natural gas, but then a large retracement occurs as the risk premium then bleeds out. There's nearly 50 years of data behind that pattern, and it's very real. But what I want to focus on today is that the situation in the Middle East now is different. The Strait of Hormuz has effectively been closed since the conflict began in late February. Major oil producers in the Gulf, like Iraq, Kuwait, have started reducing production of oil in early March, really because there was nowhere to send the oil and storage capacity is filled up. This is going to continue and spread to other countries if this conflict continues. It's important to realize that 20%, 1/5 of global petroleum, moves through the strait in a normal environment. That supply is not moving at all right now. So when Brent or WTI spikes here, you're not looking at risk premium being priced ahead of risk. You're looking at a realized supply shock being priced continuously in a market that has no clean resolution timeline in front of it. That really changes our analysis. The retracement argument that I mentioned earlier, it doesn't hold up when the physical constraint of supply is in place. What you're watching instead is a market trying to find a new equilibrium crude price that reflects a reduced supply environment that is going to go for an unknown duration. This is a whole different animal. It has real downstream implications for inflation, for the Fed's optionality, and for the earnings picture here in the near future. For today, the point is just this. Don't pattern match this crude move to the historical template. The template doesn't apply in this case. The supply disruption is real, it's ongoing, and it's a major risk underneath this entire market setup. Here's where things get more interesting and more complicated. There's a real divergence right now between institutional positioning and the consumer level economic picture. Consumer confidence surveys have been deteriorating and are at the lowest levels ever recorded. Lower than the global financial crisis, lower than the global pandemic. Credit card delinquencies in lower income households have been climbing, and the lived experience of a significant number of American households does not match the 8-week equity rally that we've been seeing in markets recently. And I don't want to skip over that. The struggle that the average American is currently facing is very real. People are very pessimistic about the state of the current economy. But here's what institutional capital is actually saying when it stays long equities through all of this. It's not saying that the consumer is fine. It's saying that the earnings resilience of the top companies within the S&P 500 does not require a healthy consumer to keep going higher at all. It requires pricing power, recurring revenue, and global diversification. And the companies, the mega cap names doing the major work in the index, they have all three. So the divergence between equity markets and the consumer, it's not irrational. It's a structural bet being made by the big players in this space, for better or for worse. A bet that this index can continue to perform even as the underlying economy, the one most people like you and I actually live in, weakens. Is that a stable bet long term? Probably not. But not being stable long term and correcting in the next quarter, those are not the same thing. And institutions are positioned accordingly. I want to come back to the fixed income space because I think 456 on the 10-year is the most important number in this entire setup. More important than the Fed commentary and more important than the current crude price. Here's my logic. Equity markets are sensitive to the discount rate. When the risk-free rate was sitting at 2% just a few years ago, equities looked extremely attractive as there was an incentive for both institutions and retail investors to put their money in more risky assets that would yield a higher return. At 456, that math gets a lot tighter. The equity risk premium, the return that you demand to hold equities over treasuries, it's been decreasing as of late. And the cushion between this fixed income yield and asset returns is thinner than it was. But here's what a lot of people don't think about. The level of the yield is less important than the velocity that the yield is moving. The rate of change that triggers hedging activity, reprices risk assumptions, and creates the kind of volatility that actually shifts markets, that happens when rates move in a very quick manner. A 450 yield to 480 within weeks, slowly moving, is a lot different than a 450 yield moving to 480 within 4 trading sessions. We're just not there yet. The move has been gradual. And if we continue to see a sustained directional move upwards, I see the equity market rally continuing. If we see a violent move upwards towards 480, 5%, that can trigger an extreme movement downward in equities as people rotate capital from the equities market, to fixed income assets. So let me try to pull this all together. The market right now is operating on three assumptions. One, the Fed holds rates where they currently are in the near and medium term. The hike threat language is conditional and not a policy path. Two, the Hormuz closure resolves or at a minimum doesn't worsen. The supply shock is already real. What the market is betting on is that it's finite, that the ceasefire holds, that shipping resumes, and that this doesn't become a permanent feature of the global supply chain picture. Three, top-tier corporate earnings are expected to remain insulated from the broad consumer slowdown through pricing power, revenue mix, and of course, AI-driven demand. Each of these assumptions is currently holding. That's why the market has moved the way it has. If one of these assumptions breaks, we can see a correction. If two break simultaneously, we could see something even worse. The market is assigning a low but real probability that the second scenario occurs. And this is why the VIX has stayed elevated relative to the price action that we've seen, and why you're seeing institutional players build hedges in the options market, even while staying net long equities. That combination, net long with hedges, is the real institutional positioning signal right now. Not panic, not complacency, structured exposure management. They believe that the assumptions will hold, but they're managing carefully in case that they don't. Well, that's the market picture as I see it going into this week. Not the headlines, but the structure underneath. If this kind of analysis is useful to you, please subscribe to the channel. And also, check out my newly created Substack. I'm going to be posting my first essay on Wednesday, as well as another video. That link will be in the description. I'll see you then.